Here's what's coming up on the Peak Financial Freedom Show with Jim and Dan.
So a fixed index annuity with an income rider, as far as the income, how does that work? Just a plain Jane vanilla one. Someone puts their money in, what happens?
Well, they take a payout rate based on your life expectancy, or if you're married, both of your life expectancies, and that payout rate is multiplied times the amount of money that you give the insurance company, and that determines your payment for the rest of your life.
At our firm, Jim and I will never tell our clients to write out the stock market, because when you write out the stock market, it only means one thing: writing it down. And why would you ever want to write any asset value down? You just don't want to. It might make your broker money, but it doesn't make you money.
People come in every day, they're in their 60s or 70s, and they have between 80 and 95, sometimes 98% of their money in the stock market. They're at significant risk, but we've been in an 11-year bull run and they've made some money in the markets. We don't believe any client should be in that position.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hey, thanks for tuning in this week.
We got 30 minutes of great information just for you.
Don't go anywhere. The show starts right now.
Hi, and welcome to this week's Retirement True or False. Gentlemen, as usual, I got some great questions. Jim, I'm going to begin with you. There is nothing I can do to protect my assets from stock market losses. True or false?
False. And I'm going to give you two examples of that. Number one, and I'll give you an example based on case studies that we work on a daily basis. People come in every day, they're in their 60s or 70s, and they have between 80 and 95, sometimes 98% of their money in the stock market. They're at significant risk, but we've been in an 11-year bull run and they've made some money in the markets. We don't believe any client should be in that position. We have what we call buckets in our firm. We put enough bucket money in the cash bucket, and that can be treasury bonds, cash, CDs. We put it there because it's safe, it's accessible, and it makes you feel comfortable too, right? The more cash you have, the better you will feel. Number two, we believe in the stock and bond market, but we use risk mitigation strategies. We use stop loss technology. We use algorithms to mechanically manage the program, the stock and bond program, on a daily basis. And then if you want guarantees in your portfolio, we have a guarantee bucket that provides certain income for the rest of your life. So it's a matter of how do you position those buckets. How much money you put in each bucket is determined on your objectives. What are you trying to have your money do for you? So that is our philosophy in trying to mitigate the risk inside of a portfolio.
When you look at what people want with their money, they always want some liquidity. So we have to give them liquidity, but we can't make that an asset that has too much volatility. They want some growth in their portfolio, but they don't want to take too much risk. So you want to give them some growth, but try to find a way to mitigate that risk of that growth asset. And they also want another chunk of their money to be safe from losses, but more importantly, to provide them income guaranteed for as long as they live. If you can imagine just in your head, liquidity for safety, growth, but try to reduce the risk on it, then a guaranteed plan to provide you income forever. That's the three bucket system that we find works really well for retirees.
And clients really get it once they see this all graphed out.
Dan, my next question is for you. If I am 55, 60, or 65, it makes a lot of sense for me to buy a life insurance policy to create projected tax-free income at some time in the future. True or false?
False. And we see this done a lot. We see clients 55, 60, and 65 being sold these life insurance policies. Well, they'll fund $50,000 a year for either 10 or 15 years in the hopes of 10 or 15 years down the road getting some form of tax-free income. There's no guarantees on the monies. There's no guarantee it's going to grow. There's no guarantee they're going to have anything left at that point. And yet we see these advisors selling these policies. It's because in a lot of cases, the commissions on these plans can be as high as 100 or 120% per year on those contributions. So someone puts in 50 grand, the advisor might get paid $50,000 to $60,000 to set it up. So the advisor's not setting up for the client. The advisor is setting up for themselves. And the only way it will work is if they fund it for 15 years and then get a significantly high rate of return on this plan for the next 15 years. Otherwise, it's not a good deal for the retiree.
But the client gets cajoled into these types of investments because they don't understand them, and they end up being in a position they shouldn't be in.
Jim, my last question is for you. I am age 65 and retired. I should just listen to my broker when he keeps telling me not to worry about stock market volatility and losses because we will always recover.
I can't tell you, first of all, it's false. And I can't tell you how many hundreds of times I've heard that come from consumers that we're providing second opinions on. That their advisor, their broker, actually tells them that because the industry has told people that stay the course, stay in the market, and you'll get your money back. That depends on when you invest your money and what happens to the market thereafter. Are you investing your money at the beginning of a bull market or at the end of the bull market like we're at right now? So you have to be very, very careful because this is your money, it's nobody else's money, and you have to make sure that you understand exactly what your money's supposed to do for you, not where the investment's going to be positioned, but what your money's going to do for you and how much you could lose. And don't take the word from any advisor or any broker or any internet search. This is all you got. You've saved it for 40, 50, 60 years. You're in retirement. You have to safeguard that money because if you lose it, you may never get it back.
Jim, Dan, thanks so much. Great topics today. If you want more information about what we spoke about, hey, pick up the phone and give us a call right now or go to our website. And don't go anywhere. We'll be right back.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hi, I'm Dan Ahmed. My partner Jim Files and I are co-founders of Peak Financial Freedom Group. We are proud sponsors of this show. As investment advisor representatives of our own RIA, we are legally bound by a fiduciary duty to our advisory clients. Specifically, we owe our advisory clients an affirmative duty of utmost good faith, requiring us to provide full and full disclosure of all material facts and obligating us to employ reasonable care to avoid anything misleading. We design customized written retirement income plans for retirees and soon-to-be retirees. If you've saved a lot of money for retirement and don't want to lose it, don't want it to run out, and don't want to make a mistake with it, stay tuned. You're going to love the show. We want to help you protect your assets against large stock market losses, earn competitive returns without taking excessive risk, and create dependable monthly income that will last for as long as you live. Our goal is to help you stop worrying about your money so much by building you a customized written retirement income plan. We put everything in writing. And here's the best news. We will not charge you for your plan. You will never feel any obligation or pressure to work with us. It's always your choice. But if you do decide to become our client and you're looking for some growth without taking excessive risk, we get paid advisory fees on the money we invest for you. If on some of your funds you're looking for protection against stock market losses and need dependable lifetime income, and we use an annuity as part of your plan, we are paid commissions. That's why we don't have to charge you additional planning fees to create your customized, comprehensive written retirement income plan. Before you invest any money with us, we will tell you all the fees you will pay in writing. We believe in transparency. And after we build your plan, you won't worry about your money so much. Sit back and enjoy the show. Thanks for joining us.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome to this week's edition of Peak University. Today we're going to talk about retirement income goals, and there's two big ones. Number one is that your income's dependable, and the second is that your income can grow. In our latest book we just wrote, it's a bestseller with Jack Canfield. He wrote Chicken Soup for the Soul, which sold over 500 million copies worldwide. Our new book is titled Mama's Secret Recipe for Retirement Success, and we spent a lot of time going over what retirees really want, and that's dependable income, and they like that income to increase in the future, don't they?
They surely do. They want increasing income for a number of reasons. Number one, they're all worried about inflation, right? Costs are going to increase, and if you had a financial instrument that potentially had income increases, it would make people feel much more comfortable, and it would ease their whole anxiety through the rest of their life by knowing that they did have an opportunity to potentially get increasing income.
Well, think about the stock market. Everyone's always told, invest in the stock market because that will allow you to keep pace with inflation.
Right.
Well, what if we have volatility in the stock market or losses? What's the chance someone's going to be able to actually keep pace with inflation, meaning increasing income, let alone even keep the same level of income without it reducing over time?
Well, if you lose money in the stock market, which you have to assume you're going to if you're in the stock market at some point in time, getting increasing income is very difficult. Even getting consistent income is very difficult because income from the stock market is maybe income. It may not be there when you want it because markets ebb and flow.
Well, and I think that goes back to the two things we want. Dependable income and income that could potentially grow.
Yep.
That's what people are really searching for. So we created this chart to help educate people in this version of Peak University. And it really talks about what's called a fixed index annuity with an income rider that has potential income increases. Because one of the negatives that's talked about with annuities out there is that once you turn on your income's static, it's flat, it never goes up, which guarantees you're going to lose ground to inflation. Is that one of the myths out there?
That's one of the myths. And some products do work like that, correct, Dan? But there are other products that do have potential for income increasing, and that's what we're going to talk about today on this chart. So the consumer gets an idea of what's available in case they are looking for increasing income in the future.
So a fixed index annuity with an income rider, as far as the income, how does that work? Just a plain Jane vanilla one. Someone puts their money in, what happens?
Well, they take a payout rate based on your life expectancy, or if you're married, both of your life expectancies, and that payout rate is multiplied times the amount of money that you give the insurance company, and that determines your payment for the rest of your life. If it's fixed, it's never going to change. It's going to be consistent for the rest of your life, no matter how long you live.
But it's guaranteed.
But it's guaranteed.
Against all stock market losses, no matter what happens.
That's correct. Right. It'll be there forever. It's certain income, but you will not have increases in that type of a fixed indexed annuity.
So that would stay flat.
Yes.
So let's look at another alternative, and let's look at an alternative that'll show what happens if we have another 53% loss in the stock market, like what happened in 2001 and 2, or again in 2007, 8, 9. It happened before, it's going to happen again.
It will.
So when you have a 53% loss in the market, what do you need just to recover?
Well, if you lose half of your money, 53%, you actually get 112% gain just to get back to even. And that doesn't happen overnight. That could take years upon years. And remember, if you're using your assets for income and you lose that much of your portfolio, what's going to happen even if you do get a gain? You'll probably deplete your portfolio even more because you're taking out income off an asset that's declined in value.
When you talked about needing years and years of big gains, if you lose 53%, you would need to make an 11.4% gain every year for 7 years just to get back up to even. Now think about it. You make 11.4% per year for 7 years, and all you've done is recover, assuming you're not taking income out and you're not paying any fees. That's really tough. So how about now we wipe the slate clean and we start with something that might be a great alternative for you? What if now you have about $1 million in an asset, you put it into a fixed index annuity, and in this case, we're going to use a hypothetical $40,000 income flow, meaning this company we're assuming is going to pay you $40,000 guaranteed for as long as you live, regardless of what happens. The market crashes, your $1 million in the stock market, if you left it there, goes down to $777,000. You probably shouldn't continue to take $40,000 out. In a fixed indexed annuity, your $40,000 is guaranteed even if the market crashes. The second year the market goes down again, you left your money in the stock market, goes down to $604,000. What happens to your income?
Income stays the same.
Right at that $40,000.
It doesn't go down.
What if the market crashes again all the way down to 53%? What happens to their income?
Well, number one, your income stays the same, and you haven't lost any money because the market crashed either.
The principal portion.
That's right.
Now, here's the key. If you're in the market and you fall all the way down to 53%, you're going to now try to recover because you want to be happy and recover.
Right.
When you make this potential, hypothetical, 11.4% gain in the stock market that next year, have you recovered?
No, you haven't.
We have not recovered at all. We're still way down.
That's right.
How would you like then, when you earned an 11.4% gain in an index, let's assume this is the index, we're basing your gains in the fixed index annuity, you don't get the full index gain. In fact, all we're showing is what's called a 50% participation rate. We're assuming all you're going to get is 50% of that index, and now you get 50% credited to your income, and your $40,000 increases to $42,280, even though the market has not corrected. Or came back fully? How would someone feel if they got a raise of 5.7% on their original income at that point?
Well, imagine your neighbor was this situation. They had been losing money and they were losing income or not taking income out because they were afraid, but all of a sudden you got an income increase. You actually got a raise to your income. That would make you feel really, really good.
Really good. And let's assume all the market did was recover and you keep getting only half of that gain, so you're not even getting close to the market. You're getting an index of about half, and at the end of the 10-year time period, you now are up to what level of income?
Well, you're up to, in this example, $58,960. And again, this is a hypothetical example here, but it gives you the idea of how this type of increasing income could potentially benefit you in retirement.
So at that point, we're up to $58,960. What happens if the market crashes again? Typically, you're in the market. What happens to your $58,960?
It stays exactly the same.
So even though the market crashes at the back end, you never go down below that $58,960.
No. So if you're interested in more information, just call the number or go to our website.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hi, I'm Dan Ahmed, president and co-founder of Peak Financial. We are a full-service retirement planning firm, not just someone who invests your money. We build customized, written retirement income plans. Have you been able to get good information on how to plan for a safe and secure retirement? Probably not. Well, we wrote the book to change all that. It's titled Mama's Secret Recipe for Retirement Success, and we co-wrote it with Jack Canfield, who wrote Chicken Soup for the Soul. We're biased, but we think it's the best book currently available on how to plan for a safe and secure retirement, teaching you the truth about risk, the stock market, fees, creating dependable lifetime income, annuities, and a full written retirement income plan. Our clients typically have between $1 million to $20 million of assets, but if you've saved at least $500,000 for retirement, our book can help you. So don't wait, call the phone number on the screen right now. We'll give you all the secrets and it's free.
Do you have a national plan, or do you just receive statements from where your money is invested? Too few retirees and pre-retirees don't have a plan and are not prepared for retirement. A great way to get a clear, written retirement plan is to meet with a full-service retirement planning firm, not just someone who invests your money. If a clear, written retirement plan is something you want, be one of the first 5 callers right now and you'll receive our Peak Retirement Navigator review. Here's what you'll receive from your Peak Retirement Navigator. Number 1, a fee audit exposing your direct and hidden fees inside your portfolio. Number 2, a risk report showing you how much you could lose in a market decline. Number 3, a risk analysis to protect your investment from large stock market losses. And number 4, an income plan showing you how much income you will need in retirement. So don't wait. Call the phone number on the screen right now for your no-cost, no-obligation Peak Retirement Navigator review, which includes your Retirement Survival Toolkit. You have nothing to lose, there is no pressure, there is no risk, and it's free. And remember, at Peak Financial Freedom Group, we fix your money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hi, and welcome to this week's Is Your Retirement in Jeopardy? Gentlemen, are we ready?
We're ready.
Dan, you should always ride out the stock market and you will always get a 10% or higher return.
What are the 2 biggest myths your brokers will tell you?
You are correct, Dan.
When you look at those 2 things, riding out the stock market, it really makes no sense. At our firm, Jim and I will never tell our clients to ride out the stock market, because when you ride out the stock market, it only means one thing: riding it down. And why would you ever want to ride any asset value down? You just don't want to. Might make your broker money, but it doesn't make you money. The second thing is that you're going to get this 10% rate of return because you take all this risk. That's probably not going to happen either, because you can look at from 2000 through 2018, a period of 19 years, the S&P 500 only increased by 2.85% per year before fees. So how in the heck are you going to get 10%?
Jim, I have 3 sets of numbers here. The first one is 2.85%. The second one is 4.06%. And the last one is 2.61%.
What is the returns on the S&P 500, the Dow Jones Industrial Average, the NASDAQ over the last 19 years?
You are correct.
Oh, thank you, thank you. You know, people don't really understand this. When they invest in the stock market, they've been told by their advisor or the internet, or they've heard someplace that I'm going to get a 10% rate of return. Well, you may very well get 10% or more in some years, but you have to understand you'll have losses in other years. Those actually were the compounded annual returns over the last 19 years. You probably would have been better off just putting your money in CDs 19 years ago.
Gentlemen, thanks so much. And thanks so much for tuning in for this week's Is Your Retirement in Jeopardy? And if you'd like more information about anything we spoke about here today, hey, give us a call in the office or go to our website, and don't go anywhere. We'll be right back.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Are you worried about taking too much risk, paying high fees, creating dependable monthly income, your money running out? You can stop worrying about your money by meeting with a full-service retirement planning firm, not just someone who invests your money. Call right now to receive your free, no-obligation Peak Retirement Navigator review that includes a total fee audit, a risk stress test showing your potential losses, a retirement income analysis showing how long your money will last, and the steps to create a customized written retirement income plan. Our clients typically have between $1 million to $20 million of assets, but if you've saved at least $500,000 for retirement, we will meet with you free of charge to see if we can possibly help. You'll get free educational copies of Mama's Secret Recipe for Retirement Success we co-wrote with Jack Canfield from Chicken Soup for the Soul, and our beautiful, inspiring 100 Shades of Financial Freedom. So don't wait. Call the phone number on your screen right now. You have nothing to lose, there's no pressure, there's no risk, and it's free. And remember, at Peak Financial Freedom Group, we fix your money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Jim, I'm so excited for this week's episode of We Fix Your Money. This gives us a really good chance to show the viewers how we'd create a comprehensive written retirement income plan. And there's a lot of details, but it really shows how we can simplify their money for the first time. And we think that's key. So we're going to talk about this hypothetical couple called Kirk and Lisa. So let's assume he's 66, she's 68. And let's pretend they retired 4 years ago. He gets a single life pension, meaning he gets income for as long as he lives. But if he dies, she gets nothing. And they chose this option together thinking, hey, let's get the maximum income, which we like people to choose joint life incomes. But in this case, as a single plan, we have to plan for them. They have about $1.9 million of total portfolio assets. They haven't used any of their money, and they want to travel. They're worried about so many things, just like everybody else is right now. The risks they're taking and how much they possibly could lose. Her financial security if he dies, because if they lose his pension, that's going to be a killer financially to her. We want to make sure they're creating the maximum income because they want to live their life right now. They want to do it all now. So, of course, they're worried about their money running out. Could they be paying too much in income taxes? Could they be getting hit with excessive fees? And they'd like to leave whatever's left to their beneficiaries. They've had a big bank broker for many, many years. They think he's a nice guy and he's friendly enough, but really never really get any answers. And it's really bothering them now, especially because she's in this potentially financially perilous position. And they've never had a written plan, and they want one for Lisa. So that's why Kirk wants to plan. He wants to make sure his wife that he loves is taken care of. So what's the first step then that we would take for this kind of couple? Well,
the first step we have to take with all couples is to determine how much risk they have in their portfolio, because no income plan works if you lose half your money. So we have to establish a baseline. Where are they at right now? So we use an outside third-party company. They do a risk analysis on behalf of our clients, and they came back with the data, and it was determined that they have about a 36% risk factor inside their current portfolio, which means if we have another 2008 financial crisis, they're going to lose about 36% of their money, which is about $685,000, which was completely unacceptable to them. They had no idea they had this level of risk, which means they have to have about a 56% recovery gain just to get back to even.
Well, in this case, if someone loses 36% in the market and they need to use that to create a lot of income for the spouse, the surviving spouse, what's the chance that income is going to last for as long as she lives if we suffer that type of loss and are taking substantial amounts of income off of that portfolio?
Very unlikely if they maintain the same income amount. So they're going to have to radically alter their lifestyle if something like this happens. And nobody wants this to happen. And this risk factor is common. We see this very often in portfolios.
But how many people come in think they have that type of risk factor?
Nobody, or very few. They think they might lose 10% or 15%, right?
So people come in with $1 million, $2 million, $3 million, $4 million, $5 million, $10 million, $20 million of assets. We do an analysis for them. They think they have 5% risk, maybe no risk, or maybe up to a maximum 10% risk. And then they're shocked to find out they have 3 or 4 times that level of risk.
Well, the problem is in the industry, they categorize risk not by dollars and cents like we're doing. They're categorizing it based on, are you conservative, are you moderate, are you aggressive? And that definition of whatever they selected is different for all people.
So they put a costume on each of those risk levels.
Yeah, we do. We want to know exactly, well, not exactly, we want to know the range of how much they're going to lose in the event the market drops again, based on historical data points. We remodeled their portfolio, readjusted the asset classes, and now we reduced their risk potentially down to 9.9%. And rather than losing $685,000, they were more likely to lose in a range of about $200,000, and we need a recovery gain of about 11%, using the same data points. Now, all of a sudden, not only did they understand their money, but they felt much more comfortable with the risk factor.
Heck yeah, because they get to dial in how much risk they want to take. They don't have to leave it to chance anymore.
That's right.
It's their decision. You have to understand, it's your decision how much risk you take. It's not your advisor's decision.
That's right.
You do not allow your portfolio to be naked out there with unlimited risk. You put that protection so you know what range of risk you're in. Now you can start making good financial decisions. Well, after the risk analysis, then we do what's the most important document, and that is show them how they're going to use their assets to create income for as long as they live. So in this case, we're going to really do a complicated exercise, but we're going to simplify the heck out of it for you, just like we would do for this type of couple. So in this case, we're going to show on one page where each income source comes from for the rest of their life. In this case, we're going to project out for 30 years. It's going to project out till he's 95 and she's 97, so for 30 years. It's going to show all their income sources, whether it's the Social Security, whether it's the pension incomes, whether it's some stock that they had, whether it's some stop-loss money that we invested, whether it's some guaranteed income from annuity type products that we would use for them, how much money we left in the bank. All that's going to be outlined for them, and it's going to show that ultimately right now, while they both are living, they're going to get about $103,000 of gross income while they both are living. The problem is, if you look at what his single life pension was, it's $13,000, plus we're going to lose some Social Security, that's going to be lost. So we had to make sure this allocation was okay if he was gone. So then what we did, we wanted to make sure that she was protected. So we do a second income analysis that we call a survivorship analysis. And in this case, her as a survivor, what happened putting that type of plan together to make sure she was safe?
Well, she still had enough income and she felt comfortable because she understood her money, and she was really concerned about this, because building a plan isn't about what we want to do for the client. It's what the client wants their money to do for them. So what we're doing is we're taking direction from the client based on the objectives they're trying to achieve inside their portfolio.
So in this case, they had about $100,000 of joint income between them. You can see in the blue and the red columns, there's zero there because she lost his single life pension,
right,
and she lost one of their Social Securities, and we still were able to maintain about $82,000 of income for her for as long as she lived, which was going to be enough. She also had a high probability she was going to leave anywhere from $1.4 million to $1.5 million if she just uses and retains about a 4% gross rate of return on her money. That's how much she can possibly leave to her beneficiaries. So it just works great. So if you're like this couple and you're really worried about both of you, but also worried about the survivor, just give us a call. We'll be glad to work this type of data out, this type of plan together for you.
And remember, at Peak Financial Freedom Group, we help fix your money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Do you have an extra plan, or do you just receive statements from where your money is invested? Too few retirees and pre-retirees don't have a plan and are not prepared for retirement. A great way to get a clear, written retirement plan is to meet with a full-service retirement planning firm, not just someone who invests your money. If a clear, written retirement plan is something you want, be one of the first 5 callers right now, and you'll receive our Peak Retirement Navigator review. Here's what you'll receive from your Peak Retirement Navigator. Number 1, a fee audit exposing your direct and hidden fees inside your portfolio. Number 2, a risk report showing you how much you could lose in a market decline. Number 3, a risk analysis to protect your investment from large stock market losses. And number 4, an income plan showing you how much income you will need in retirement. So don't wait. Call the phone number on the screen right now for your no-cost, no-obligation Peak Retirement Navigator review, which includes your Retirement Survival Toolkit. You have nothing to lose, there is no pressure, there is no risk, and it's free. And remember, at Peak Financial Freedom Group, we fix your money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hey guys, great show this week. Thanks so much for tuning in.
If you need any additional information, just call our office or feel free to visit our website.
And remember, at Peak Financial Freedom Group, we fix your money.
The preceding program is sponsored by Peak Financial Freedom Group.